Welcome to the deep dive. Today, we're wrestling with a single number that lives right at the core of every single valuation: beta.
That's right. The Greek letter, data dollar.
Okay, let's unpack this. If this one number is off by, say, just 20 basis points, your entire discounted cash flow calculation can be, well, garbage.
Complete garbage. It defines your cost of equity, which then drives your WACC. Getting beta right is probably the highest impact decision you'll make in the whole model.
So at its simplest, what is it?
It's a measure of sensitivity. How sensitive is an asset returns to the overall market's movements. A beta over 1.0 means it's more volatile than the market.
And less than 1.0 is more defensive, more stable.
Exactly. But our mission today is to tackle two major structural flaws with the raw historical beta that everyone starts with. We need to figure out how analysts actually fix it for a reliable forecast.
Okay, so flaw number one. I'm guessing it's about debt. You can't compare a company loaded with debt to a startup with none. How do you get to an apples-to-apples comparison?
You've got it. You have to separate the operational risk, that's the pure business risk, from the financial risk that comes from debt.
And that gives you two different betas.
Two different betas. First, you get the unlevered beta, or beta. That's your pure business risk, perfect for comparing across an industry. Then you have the levered beta dollars, which is the total equity risk you'll actually plug into the CAPM.
So how do you make that separation? What's the tool?
The tool is the Hamada equation. It uses the company's tax rate and its debt-to-equity ratio to unlever the beta of peer companies and then relever it for your target company.
And that tax rate part is crucial, isn't it? The 1-2.
It's absolutely critical. It accounts for the interest tax shield, which is why debt is fundamentally cheaper than equity. It isolates the true risk.
And this is where the high-stakes mandate comes in. When you relever that beta, you have to use the company's target capital structure.
You must. If that D/E ratio doesn't perfectly match the weights you use for your WACC calculation, the entire model just bopulate. It fundamentally breaks down.
Okay, so we've stripped out the noise from debt, but you said there was a second, even deeper problem.
Yes. This one is rooted in time itself. See, raw beta is backward-looking, and it's inherently unstable because of a phenomenon we call beta drifting.
Drifting?
Drifting. Empirically, raw betas tend to drift back toward the market average of 1.0 over time. It's mean reversion in action.
So like a rubber band, it's always being pulled back to the middle.
Perfect analogy. So just trusting a historical beta of, say, 1.5 or 0.5 for your forecast is a recipe for error.
But wait a second, why would we just override hard historical data? Isn't forcing the beta toward 1.0 just, statistical manipulation?
It is manipulation, but it's necessary manipulation. It's called the Bloom adjustment. And it's standard industry practice because it just dramatically improves the predictive power.
So what's the formula? How does it work?
It's surprisingly simple. You take 1/3 of the market beta, which is 1.0, and add it to 2/3 of your raw historical beta. So you're respecting the historical data, but you're also acknowledging that it will likely regress to the mean.
Got it. So we've handled leverage, we've handled drift. What about investors who aren't diversified? Like a founder with 90% of her net worth in her own company. The CAPM model doesn't really apply there, does it?
It doesn't. And this raises the mandate for something called total beta. This measure includes both systematic market risk and all of that unsystematic company-specific risk that a concentrated owner is exposed to.
It's a huge distinction because standard CAPM just assumes this mythical, perfectly diversified investor.
Exactly. And if you fail to use the higher total beta for that founder, you're understating her true required return. That artificially lowers the cost of equity and inflates the company's valuation. For her, it's just wrong.
So to recap the two big mandates.
Yeah.
Adjust for leverage with Hamada and adjust for historical drift with Bloom.
That's the core of it. But, even with all these robust adjustments, academics still criticize CAPM for factor deficiency. They argue that other things, not just the market, drive returns.
Right, like the FAMA French three-factor model, which adds in factors for company size and value.
Precisely. Those models have more statistical power.
Which brings us to our final provocative thought for you to explore. Even though these multi-factor models are theoretically more robust, why do you think practitioners almost universally stick to the simpler single-factor adjusted beta for real-world valuation? Is simplicity always the ultimate driver of industry standards?